What is up, everybody? Jonathan Wells here, back with another video. I'm so excited to be answering some questions from some viewers that I have. They're asking, and I'm excited for this segment where I'm answering questions that were emailed in about everyday financial situations. Hi, I'm Jonathan Wells. I'm the host of the Educated Lend podcast. I'm a mortgage lender right outside the Chicagoland area. And my passion is personal finance. So I want to share with you some educational questions that I've seen from different viewers and answer those in a public forum so that maybe some of your financial questions will be answered in this as well. And if not, shoot me an email. I'd love to feature your question. So without further ado, let's get into the video. All right, everybody, welcome to Educated Lend, the podcast where I answer your mortgage, finance, and real estate related questions. Today, we're going to be hearing from Victoria from Chicago. So Victoria's question is, how should I balance my mortgage payment with my retirement savings if I can afford to do both aggressively? So she's 32 years old, has a stable income of $150,000. She maxes out her 401k and Roth IRA each year. She just bought a home with a 30-year fixed rate mortgage at 6.25%. She's got $300,000 left on that loan. Would it be wiser to allocate extra funds towards paying off my mortgage early, or should I put that money into a taxable investment? How do I calculate the opportunity cost in this scenario? So this question is pretty diverse, and you can take this down a lot of different rabbit holes if you're looking at really maximizing the opportunity cost, because you'd have to weigh, your mortgage interest rate versus the average return in the stock market. And I'm just assuming you're going to be putting it into some kind of an index fund, that's going to be paying roughly 7 to 10% annually. And again, it's not going to be every year that you get those returns either. So you have to balance that out. Plus the fact that based on your interest rate, looks like you purchased your home within the last 2 to 3 years. So you're probably making the minimum payments on that too. And you've got anywhere from 27 to 25 years remaining. And so a lot of the interest on mortgages are front loaded. So you're paying a significantly higher, interest portion on that payment for the first 10 years. So again, there's a lot of different things you can do to really nerd out and look at, the cost of every single thing, break evens and opportunity cost in that scenario. However, I'll answer this as if it was my personal situation, which I would recommend at that point. Let's say you've got $20,000 a year that's coming in additionally above and beyond your current means and what you're currently saving. Honestly, I would just split that down the middle. I put half towards my mortgage. I put the other half towards, your taxable investments. Great question. Really appreciate the enthusiasm. And, again, I would just do both because again, you're securing the fact that you're not paying additional mortgage interest. You're prepaying that loan and you're getting that paid down. And again, that's above and beyond maxing out every other tax advantaged account that you have. So that's really the stage where I would start to pay extra on the mortgage in addition to making taxable investments. It's a great problem to have. You're really on the right track here. Give it a few more years and you'll probably hit a 7-figure net worth status. Now, our next question comes from Greg from Tampa. Greg asks, how does my student loan repayment plan affect my mortgage approval? He has $85,000 in student loans. He's on an income-driven repayment plan. His current payment is $250 a month, but if he switches to the standard repayment, it would jump to over $900. How do lenders factor student loans into my debt-to-income ratio? And would switching repayment plans help him qualify for a higher loan amount? So, Greg from Tampa, here's a few different things that you can be doing to ensure you get the most out of your financial goals with this student loan debt. So number one is that when you're qualifying for a mortgage, if you're currently making payments on the income-driven repayment plan, you are allowed to use that repayment as the actual payment that you're using when qualifying. So in this case, we would use the $250 a month to qualify you for a mortgage because that is the current payment plan that you have set up. Now, if you'd like to switch that and go to the $950 a month and actually put some money towards the principal on that loan, then we now have to use the $950 payment for you to qualify because that is your current payment agreement. If it was me personally, it just really depends on how much income you have. If you can float covering a mortgage, utilities, expenses, and the $950 a month towards paying down those student loans, I would look at that option because again, we want to make sure that we are balancing those student loan repayments in a wise way that does not continue to get you into debt, because you don't want to look at this debt 5 years from now and now it's over $100,000, right? You want to make positive improvements on your financial situation. So I would make sure that you can afford a home while also being able to chip away some of those student loan debts that you have and get yourself to a point where eventually, maybe when you sell your home and move up to your next home, knock out the rest of those student loan payments and complete that milestone of your financial journey. We now have a question from Phil from Denver. His question is, how do I structure my mortgage if I plan to house hack and rent out rooms? So Phil is buying a duplex and plans to live in one unit while renting out the other. His lender says he qualifies for a conventional mortgage, but he's heard that FHA allows for lower down payments on multifamily properties. How can he determine the best loan structure? And can he use the projected income to qualify? So, Phil from Denver, another amazing question that you've posed here today. This is a situation that I honestly see a lot of young professionals do, especially if they're relocating to a new city. So if you're looking to, get your first property and you want to keep your expenses low while also investing in real estate, this is an amazing opportunity for you to get in that rental game without putting down 20% and also decreasing, the lifestyle expense that you have, which is a mortgage. So depends on your current situation, with, spouse, girlfriend, boyfriend, kids, whatever. If you are, I'm going to assume you're a single man going into this here. Here's what I would do. If you got friends that are in the area and you would like to live with your friends in the same house and maximize your value, listen up. So first thing you can do is you can absolutely use the rental income to help you qualify for the property that you are purchasing. This is applicable to only 2 through 4 units. You can't do this with a single family because there's no real method for us to see, how you can actually, sustain renting out a room inside of that single family property. But this is a great option for multifamilies. Now, Fannie Mae has updated their guidelines so you can put down 5% up to a 4-unit purchase for primary residences only. However, pricing might not be the most advantageous for that. I would definitely look at an FHA option. It allows you to put down less money, 3.5%. And, it's been established as a loan product in this space for a little bit more time than, the conventional loans have from a down payment perspective. So you can get away with 3.5% down and, be able to use just that money to get into this property. Now, what I would do is I'd look at 2 units. They are typically the best for this, because you don't run into any additional challenges that FHA would require. But what you're able to do is purchase the property, rent out the one side. Let's say your mortgage payment is $2,500 a month and you're getting $1,600 from the other side. You're now in for $900 yourself. Get 2 of your buddies to rent out 2 rooms inside of the unit that you are occupying, and all 3 of you live there. And now if you're charging each of them $450, you're living for free. Everyone's paying your mortgage. You're able to, save money on your taxes by doing this. And you're also building equity that everyone else is paying for. So I love this opportunity for you. I think it's a great thing for you to do, is to buy a 2-unit, rent out the one side, rent out the additional rooms that you're not using to your friends, make that money, do that for 2 to 3 years, go buy another one, do that for 2 to 3 years, buy a single family home that you can live in yourself, call it a day. You may never have to actually make a mortgage payment. So I love this. And lastly, we've got Mark from Indianapolis who wants to know, is it better to use a 401k loan or a home equity line for a down payment on an investment property? So Mark asks, I want to buy a rental property, but I don't have enough cash for the 20% down payment. I have $250,000 in my 401k. I have $100,000 in home equity. Should I take out a 401k loan and pay myself back with the interest, or should I use a home equity line of credit to fund my investment? So, Mark, it just depends on your risk tolerance. Personally, for me, I don't borrow for down payments on investment properties or businesses. If I were to purchase a business, I wouldn't borrow money to do that. That would be a portion of, one of the later steps, in our forward plan. That would be more, this would be a stage where I'm already in to, or use a home equity line of credit to fund my investment. So Mark, personally, I don't borrow for my investments when it comes to like down payments and things of that nature, right? So if I were to purchase a rental property or anything else that I can use to give myself more cash flow, I may take a loan out on it when I purchase it, but I'm not taking a loan out for the down payment, if that makes sense. I always want to have some margin. And this ties into step 7 of my forward plan, where that's the point where I'm investing above and beyond everything else. So if I have to borrow against the investments that I've already built and the equity I already have in my personal home, I'm probably not quite yet to step 7, or I've just hit step 7 and I really need 6 to 12 months of saving additional income above and beyond maxing out my tax advantaged accounts to get to the point where I can actually make this purchase. So that's my answer. Is personally, I don't borrow, but if you were to borrow and you wanted an option to get this property, it really depends on the breakdown of what your cash flow is going to be and everything. I would talk also with, some tax strategist like a CPA, or like a CPA or your financial advisor. Personally, if it was me, I probably would lean more towards the home equity line of credit option because I'm not touching my retirement accounts at that point. It's easier for me to do that. And there's typically less implications for me later on. But again, if it was me personally, I would actually just cash flow that money, save that, and then make the down payment myself. Of the 20 to 25%. And I would also have some reserves tucked away just in case, something happens to the property in the first 6 months to a year of owning that property. So I hope that answers your question. Again, I'm a little bit more risk adverse than, the next person. So for me personally, I wouldn't borrow to go buy an asset when it comes to the down payment. So thank you so much for watching. I really appreciate it. Please give me a like on the video. Also drop a comment, subscribe, share to a couple of friends if you got some value out of this. If you want your questions featured on this weekly segment of my YouTube channel, go ahead and email me at educatedlend@outlook.com and I'll make sure to feature your questions in the next video. Until then, make it a great day and I'll see you in the next video.